If you're a wealthy Canadian with a vacation home in Arizona, U.S. stocks in your RRSP, or significant assets on both sides of the border, this video is about a tax most Canadians don't think about until it's too late, the U.S. estate tax. And in 2026, the rules just changed in a way that affects your planning strategy directly. The One Big Beautiful Bill Act, signed in July 2025, permanently raised the U.S. federal estate tax exemption to $15 million per person, indexed to inflation going forward. This is a meaningful change, and it removes the sunset risk that had been hanging over estate plans for years. But here's what most articles won't tell you. For Canadians, the full $15 million exemption doesn't apply. You get a prorated version based on how much of your estate is U.S. situated, and the math can still leave you with a significant tax bill. Let me show you how this works in practice. Say your worldwide estate is $20 million. Your U.S. vacation home and U.S. stocks are worth $4 million. That's 20% of your estate. Your prorated exemption is 20% of $15 million. That's $3 million. Your U.S. estate tax applies to the remaining $1 million at 40%. That's a $400,000 tax bill on a vacation property and some stocks. Now, what counts as U.S. situs property? U.S. real estate, shares of U.S. corporations held directly even inside your RRSP, and debt obligations of U.S. entities. But here's the planning opportunity. Canadian mutual fund units and ETFs, even those holding U.S. stocks, are not U.S. situs property. So if you're holding Apple or Microsoft through a Canadian fund instead of directly, you've removed that estate tax footprint entirely. There's also a double taxation risk that's worth understanding. Canada has no formal estate tax, but it does apply a deemed disposition tax at death, which can trigger capital gains tax on appreciated assets. If that same asset is also U.S. situs property, you could be facing taxes from both countries on the same asset when you die. The Canada-U.S. tax treaty has a foreign tax credit mechanism to reduce this, but it only works if your estate plan is structured correctly in advance. For high net worth Canadians with significant U.S. exposure, the 2026 changes are a good trigger for a cross-border estate review. Particularly, check your U.S. equity holdings and consider whether Canadian domiciled funds achieve the same investment objective with less estate tax footprint. Review whether your vacation property ownership structure is optimal. And if you're married, understand how the marital credit under the treaty applies at the first and second death. At 49th Parallel Wealth Management, I work specifically with high net worth individuals navigating the Canada-U.S. border as a fee-only fiduciary advisor with dual credentials in both countries. If your estate plan hasn't accounted for these changes, I'd welcome the conversation. A link to book a complimentary consultation is in the description. From the desert to the tundra, we are your cross-border retirement experts.